Welcome to our deep dive into financial performance. Today, we are exploring the two pillars of financial reporting, the income statement and the cash flow statement. While a casual observer might think profit and cash are the same, a seasoned analyst knows they tell distinct stories. The income statement records revenues and expenses to show profitability over a specific period, in our case, the 2019 fiscal year. Meanwhile, the cash flow statement tracks the actual movement of currency into and out of the business. We will use a real-world example, Pete's Pizza, to see how these statements function, how they are calculated, and most importantly, how they connect to reveal the true health of a business. Let's start with the top line and work our way down. The income statement, or P&L, is a roadmap of performance. It begins with revenue, the total money earned from selling goods or services, but making those goods isn't free. We first subtract the cost of goods sold, or COGS. COGS includes the direct costs of materials and the labor specifically needed to produce the product. Subtracting COGS from revenue gives us gross profit. Next, we account for the cost of running the business, known as SG&A. Selling, general, and administrative expenses. This includes everything from marketing and advertising to rent, utilities, insurance, and the salaries of support staff. Subtracting SG&A from gross profit brings us to operating profit, or EBIT, earnings before interest and taxes. This represents the core profitability of the business operations themselves before financial or government obligations are met. To compare companies more fairly, analysts often look at EBITDA, earnings before interest, taxes, depreciation, and amortization. EBITDA is calculated by taking EBET and adding back non-cash expenses like depreciation. It's a pure look at operational earnings. We also use margins to measure efficiency. Gross margin is gross profit divided by revenue, showing how much we keep after direct costs. For Pete's Pizza, with a gross profit of $600 on $2,000 in revenue, that's a 30% margin. Operating margin is operating profit divided by revenue. Efficient companies generate more operating profit with less revenue. Finally, net margin is what's left after every single expense, including interest on debt and effective tax rates, is paid. It is the ultimate bottom line, net income divided by total revenue. Let's look at the actual 2019 numbers for Pete's Pizza. Pete generated $2 million in revenue. COGX took away $1,400,000, leaving a gross profit of $600,000. After $300,000 in SG&A, his operating profit, or EBIT, sat at $300,000. But Pete has a loan, so he paid $40,000 in interest. This left him with $260,000 in earnings before tax. Applying the effective tax rate resulted in $104,000 in taxes, leading to a final net income of $156,000. So Pete's Pizza is profitable. However, having a net income of $156,000 does not mean Pete has $156,000 in extra cash sitting in his bank account at the end of the year. To find out where the money actually went, we must turn to the cash flow statement. The indirect method is the most common way to build a cash flow statement. It begins with net income and adjusts for non-cash items and changes in the balance sheet. Why? Because of accrual accounting. We record revenue when the pizza is delivered, even if the customer hasn't paid yet. That's accounts receivable. If accounts receivable increases, it means we have profit on paper, but no cash in hand. So we subtract that increase from net income. Conversely, if we owe suppliers money, accounts payable, and that balance increases, we haven't spent the cash yet, so we add it back. We also add back depreciation, which is a non-cash expense representing the wear and tear on assets like ovens. This reconciliation transforms paper profit into actual operating cash flow. Let's calculate Pete's operating cash flow step by step. We start with the net income of $156,000. First, we add back the $40,000 depreciation expense because it didn't involve a cash outflow this year. Next, we look at working capital. Accounts receivable increased by $20,000. Since this is money owed to Pete but not yet received, we subtract it. Inventory decreased by $5,000. Selling off old stock brings in cash, so we add it. Accounts payable increased by $15,000. Pete is essentially borrowing from suppliers, so we add that. Finally, Salaries payable decreased by $10,000, meaning Pete paid out more cash to employees than he owed from previous periods, so we subtracted. The result? A healthy $186,000 in cash from operating activities. Operating cash isn't the whole story. We must also look at investing and financing. Investing activities involve capital expenditures, acquisitions of long-term assets to enhance the business. Pete spent $60,000 perhaps on a new delivery van or industrial oven. This is a cash outflow. Financing activities cover transactions with investors and lenders. Pete repaid $15,000 of debt, a cash outflow. He also paid $70,000 in dividends to shareholders, another outflow. When you sum these up, Pete's investing and financing activities used a total of $145,000. When we subtract this from his $186,000 operating cash, we find a net change in cash of $41,000 for the year. This is the amount Pete actually added to his bank account. To close the loop, look at Pete's cash balance. He started the period with $140,000. By adding his $41,000 net increase, he ended the year with $181,000 in cash. Compare this to his net income of $156,000. Pete is cash flow positive, and his operations generate more cash than his paper profits suggest. This is a sign of a healthy, growing business. By mastering the interplay between the income statement's profitability and the cash flow statement's liquidity, you gain the ability to see through the numbers to the reality of any business operation. Keep these concepts in mind as you analyze your next financial report. See you in the next lesson.